now moving on to our final session, which is an outlook for private markets over the next year. We're joined today by, just starting from the far end, Alex Wolff, Managing Director at HarbourVest. We have Con Walsh, Managing Director at ICG Enterprise Trust. Deborah Wardle, UK Alternatives Leader at Mercer, and Zach Ewan, Partner at Battery Ventures. Just a quick note before we start that I've checked, Zach doesn't mind me disclosing this, his wife is heavily pregnant and expecting their child, so he's going to keep his phone out and we'll have to check it sporadically, but he's very much engaged in our conversation. So I will start with a couple of data points from our Investor Pulse survey, one on equity and one on debt. We asked investors in a high interest rate environment whether they thought capital inflows would continue into PE funds in 2024. The majority of US investors thought that inflows would decrease. The majority of UK investors thought they would increase. So divergent opinions in terms of how fundraising will go next year. And on the credit side, we asked investors whether the rapid growth of private credit poses a systemic risk to financial markets, and it was a much clearer answer on that front. 98% of investors said that it would. So against that context, it will be great to ask for what your one big prediction for private markets in 2024 is. I'll start with Alex.
Yeah, sure, happy to. So I think what we've seen kind of in the broader market environment over recent weeks and months is probably a bit more optimism, and now even kind of the beginnings of pricing in rate cuts over the course of next year. Notwithstanding that, we think it's probably safe to assume it's going to remain a somewhat difficult operating environment into 2024, and we're probably going to remain in a capital-constrained world where liquidity is at a premium. And so what does that mean? It means that we're likely to see, from a fundraising perspective, capital kind of concentrating and aggregating towards some of the strongest, most proven managers in the ecosystem. And then at the company level, it means it's the best, most calibrated private companies that are going to have opportunities to access the exit markets and to generate liquidity for investors. So that's probably the base case kind of expectation for next year. Investors are also likely to be hungry for liquidity from their private markets portfolios in 2024, and we think that's likely to sustain continued pretty interesting buying conditions in the secondary market and the continuation market as well. So maybe stop there and hand it over to one of my panellists.
Yeah, Zach, do you want to go next?
I'll take maybe a more micro lens. So what we do is invest in tech companies across the stage spectrum. For those that have been following, tech has been a little bit out of favor in the last couple of years, but I do think that managers will shift from sort of portfolio triage and focus into deal doing mode. There will be pressure to deploy because there is still a capital overhang. The dust has settled on the big kind of known unknowns around interest rates, et cetera. So I do expect a pickup again in particularly tech buyout activity. But I don't think we'll return to what we saw in sort of the peaks of 2020 and 2021.
And is that, or we won't return in terms of volume of activity or in terms of valuation?
Yeah, it's an important nuance. I think that volumes are more likely to recover and certainly quicker than valuation sort of framework.
Mm-hmm. Makes sense. Deborah?
I think it's interesting, and maybe touching on your liquidity point, but taking it from a different angle. I think one thing that we're really seeing is more and more interest in the innovation and adoption of more liquid fund vehicles for investors. So these things, open-ended, semi-liquid, LTAFs, LTIFs, all the other acronyms that are around. And that's really becoming driven by clients wanting to access the space, but maybe being different client types. So as we move towards defined contribution pension schemes investing and with their requirements, or we look towards retail investors. And I think if I can have a 1A and a 1B, to my point, I guess my 1B would be, and with that, I think we'll continue to see more demand on GPs for more transparency in what they're providing to investors, and that's going to be driven by kind of regulatory demands on fees and expenses, but also things like SFDR, Article 8, Article 9, and the requirements of clients and what they want to see as well. So I'd say my two things would be kind of the more liquid fund structures, and as a result as well for the new investors and new entrants, more transparency requirements.
On the liquidity point, one of the sort of newer options that we've seen grab headlines has been around NAV financing, and it'll be interesting to hear some views on whether where you stand on that, whether that's just the next innovation in the market and eventually everyone will do it, or whether you think more caution should be applied and how it's used, how often it's used as well.
Yeah, I'm happy to start on that. I mean, I think, but my perspective is probably that the column inches devoted to this topic probably exceed its kind of scale of adoption in the market. So that there isn't terribly good data on the extent of NAV financing as a tool, but our feeling is it's probably fewer than 10% of GPs in the overall market who've actually used NAV financing. And then if you look at the deals themselves, they tend to be at fairly modest LTVs, so typically less than 20% and many of them closer to 10. So it's kind of, at this point at least, a minority activity, and then the deals that do happen are on a sort of fairly lowly levered basis is our sense of it. And then when you look at kind of use of proceeds for these transactions, most of them today are for incremental follow-on investment and add-on M&A in existing calibrated kind of performing assets. So that's kind of tends to be what the capital's being used for in those transactions right now. So, that's kind of our sense of it. I think in a higher rate environment, what we will see, as with all sorts of forms of financing kind of innovation, is just it focuses the mind. If you have to pay 10, 11, 12% to borrow in these sorts of transactions, that's a different calculation to borrowing at 5 or 6%. So, we'll see what that does to adoption, but I think it'll probably concentrate the mind of GPs.
Yeah. And Com, what's your prediction for next year?
My prediction. So I think, maybe following on sort of similar themes to many of the other panellists, I think the fundraising market is actually going to stay broadly similar to how it's been in 2023. So I think quite challenged. And the reason for that is quite a simple one. It's simply, I think, a imbalance between supply and demand. For a number of managers, we've seen this in 2023, they've continued to have very lofty fundraising aspirations, but that's not being met by a market where investors are under some pressure when it comes to capacity. I mean, we've all read about the denominator effect, and I think that's still alive and well. But that's been exacerbated, to Alex's point, by the lack of activity in the market, the lack of realizations, which is putting further pressure on capacity. So I think what that means is there has to be a kind of, I always think of it as a release valve. And that comes from, we're going to see, I think, in many cases, slower fundraisings, reduced fund sizes, and maybe in extremis, we may see, some hallowed names of the past. We were talking, earlier on about, some of the larger funds in 2007, going into the GFC are no longer with us. We may see that some of these hallowed names have a sort of existential crisis as a result of this imbalance. So maybe not very optimistic. So perhaps I need Christmas to cheer me up. But,
You're bringing us down.
Yeah,
That's a fair prediction. But on the point of fundraising, and thinking back to that data point that we had about particularly the US investors thinking that in a high interest rate environment, GPs will perhaps struggle to attract the capital that they're looking to raise. Which types of GPs do you think or will be successful in fundraising next year or over the next 18 months? I'll start with you, Zach.
Good ones. I think, we were talking about this earlier. I think GPs with consistency of strategy, returns are table stakes, right, for any successful fundraising. But having consistency of strategy over different cycles is critical. And the strategy needs to be ideally not indexed to one sort of lever of value creation, right? And so if you've been generating all of your returns through multiple arbitrage, especially in markets like tech over the last 10 years, or excess use of leverage, like when those variables shift underneath your feet, then that consistency of strategy kind of works against you. So I think having that level of consistency, but knowing that there are kind of multiple value drivers underneath that you have in your playbook as a firm is critical. And I think LPs are more sophisticated than ever, and so they're splicing the data every which way to see what is driving returns within their managers, so they know.
Mm-hmm. I completely agree with everything you said. I'd probably just add to it as well. From our perspective, it's about that being able to see evidence of expertise in managing through different cycles. I think where we've been for the last 10 years has been a much more fruitful environment for investing, and it's about actually being able to demonstrate that you've been through the rough and the smooth, and that you have the expertise and the skill set to be able to deliver strong returns even in harder times.
Mm. And on that point specifically, in the last 10 years, we've seen a number of generalist GPs rush into the tech space. How do you think they will fare in terms of those that have raised maybe one tech fund, or not necessarily tech, but maybe one growth equity fund next time around?
I think it depends a lot on the people, right? Like, it's about, have they got the understanding of the space? It is a niche space, although we say every company's now a tech company, so I guess it's a bit contradictory there as well, but there's still a lot that you need to understand. So I think time will tell, right? I think we'll see some generalists who've maybe gone into that specialism with the right, support behind them do well, but the ones that maybe haven't and have been more opportunistic potentially struggle.
Mm-hmm.
Yeah, and largely picking up on Zach's point, I think for us the core theme is consistency. So it's consistency of performance, but also it's the consistency of approach, strategy, the development of a strong institution, which picks up on Deborah's point that we also like backing managers that have been through cycles, and actually we quite like backing managers that have made mistakes through those cycles, because they're in a much better position. They have that institutional memory of what to do. And we saw it quite recently during, the COVID pandemic. It turned out to be quite a good time for private markets. But back in 2020, we didn't know that. And we saw our more experienced managers. They'd never been through that specific type of crisis, but they instinctively knew what to do. And I think we're seeing that at the moment as well. In a rising interest rate environment, managers that have been through these cycles just instinctively know what to do. And that's got a real power. And it's those managers that can demonstrate that will be the survivors going through the next fundraising cycle.
Yeah, I mean, a lot to agree with in all of that. I mean, I think if you take a big step back, the types of managers who will be successful this year and next year are category leaders in whatever they do. And I think what we've seen, even in this more difficult environment where particular strategies, particular bits of tech and growth investing maybe move to be more out of favour, even if you were a venture fund, a seed fund, a UK small buyout fund, a mega cap fund, if you were truly distinctive and had a competitive advantage in your particular lane and segment, you were able to raise capital. It may have taken a bit longer than it would have done in 2021, but you still got there. And if you're a true leader, you'd get there relatively quickly. So that's kind of what we've seen. And then if you kind of take it down a level to the sorts of themes that are likely to be topical next year, I think private credit will continue to be a theme, and I think we might come on to talk about that. But it's a structurally growing part of the private markets ecosystem, and clearly in the rate environment we're in today, it makes more sense for a lot of LPs than it may have done previously. So that's one thing. Secondaries, I think, will continue to be another theme for next year. There is just structurally more requirement for liquidity from private market portfolios than there is capital available on the buy side, and so that will continue to be an interesting place to invest. And then within the buyout world, I think probably small medium buyout will be more topical than large, just given that it relies to a lesser extent on syndicated financing markets to get deals done, IPO markets to exit deals, and there's just probably more potential for outperformance in those sort of strategies. So that's probably what we can expect next year.
And then thinking about fundraising and the way that LPs are changing the way that they allocate in terms of potentially writing larger checks to fewer managers. What do you make of the trend that we've started to see this year of GP consolidation? I could start anywhere. Let's start with you, Alex.
Yeah. So it's funny on this topic. There's like multiple ways to approach it. But I do think you see some things being written now, certainly over the last year, about GPs, predictions of GPs going out of business and that type of consolidation. And, Colm, I think, touched on it earlier, that in any tough cycle, there probably is ultimately some of that's going to happen. But it's a very sticky asset class. These are closed-end, long-duration funds that have long tails of management fees and economics. So the process of kind of natural selection is just a slow one in the private equity and private markets world, and that's kind of what we've seen historically. So I'm not personally expecting huge numbers of kind of blow-ups in these more difficult environments. And I think what we saw 15 years ago in the GFC, there were some firms who had to cut their cloth pretty dramatically, right? They may have been managing a fund of whatever size and had to half or less their capital under management. And that just forces a process of introspection. It makes you really reflect on what are we good at, what is our right to win, what's our competitive advantage. And you go back to the core, and either it works or it doesn't, right? And if it does, then you're going to get the opportunity to regrow AUM in more benign markets off the back of better performance. And if it doesn't, then you'll have to sort of reinvent yourself or ultimately, die. So that is kind of the process that I expect to see beginning in this cycle.
Yeah, and I would say I think the consolidation. You've got to remember that private equity is a very nascent asset class, and since 2007, depending on how you measure it, but roughly it's kind of tripled in size. So I think some of this consolidation is a natural evolution of the market. And I think, as I look at it both as an investor, but also, frankly, as somebody who works for a large, diversified private asset manager, I think, it's giving investors choice, because for some investors, they want to have a one-stop shop. They want to be able to back the same manager from multiple different strategies. And they want perhaps the more sophisticated platform that enables them to get reporting on ESG, or they've got bespoke requirements which a larger platform is more easily able to accommodate. But on the other hand, many investors see the power of investing in single strategy managers, perhaps see a closer alignment. And I think the market will continue to deliver that choice to investors. And I think some of this through flow, the successful managers accumulating assets, becoming bigger, new managers coming through, it's a healthy part of the development of the market.
Probably two things I'd add to that. The first, I guess, from an investor standpoint is, the potential more challenging fundraising environment. It's actually quite good for a lot of investors. They're getting access to GPs maybe they couldn't get access to before. So it can actually be quite positive from if you've got capital to deploy standpoint. On the second piece, and again, thinking about consolidation, and we see it kind of with private market managers combining, but we also see it with kind of combining public and private. And as to my earlier comment about a kind of prediction-wise and thinking about more liquid fund structures, being able to manage kind of the liquid and the illiquid piece together in one vehicle to deliver clients that, I guess, allocate access to private markets, but also in potentially with some element of liquidity, I think could be seen as a positive as well.
Zach, do you have a view?
I think it's really interesting. It logically makes sense, right, to some Alex's points on and Colm's points on where the market is and where it's heading. But there's a very sort of human element to private equity that I think is a little bit unique. And what we've seen are a lot of private equity firms selling minority stakes. It's been a big trend over the last few years. That's a fundamentally different transaction than bringing two companies together. And when you bring two businesses together, you need to have tricky discussions like relative valuation, et cetera. And it kind of gets to the core of what is a private equity firm worth. It is an apprenticeship business at the end of the day. It is very people-based. And I can't imagine many firms getting in the same room and quickly agreeing to what one is worth versus another, because there's a lot of ego in the business, and there's different methodologies in terms of how people value GPs, value carry, mark their portfolios, et cetera. So I think it makes sense intuitively, but in practice, I think it's quite difficult to pull off. So I guess the punchline being, I tend to agree. I don't see it kind of picking up massively, but given that there's been a pretty heavy dose of humility in the private equity market in recent history, you could see more of it.
Okay. And then going back to that second data point on private credit, it's an area that continues to scale rapidly. But at the same time, the amount of criticism that it appears to be drawing, or the amount of doubt it's attracting, is also scaling rapidly. Where do you stand on private credit, and particularly the stat of 98% of investors think it poses a risk to financial systems?
Probably more in the 2% than the 98. But no, look, I mean, I think the landscape changed massively since I started in this industry kind of 15, 16 years ago. Private credit, certainly in Europe, but frankly globally, was a very small part of the financing landscape for companies 15 years ago. Today, it's grown to be a very important part of the kind of private capital markets. And it's still probably undersupplied relative to the private equity market. So you look at private equity and it has about $1 trillion roughly of dry powder, and there's about $250 billion or so of dry powder in the private credit market. So if you think most transactions are levered somewhere in the range of 1-to-1, there's plenty of kind of headroom for the asset class to grow. So I think it's not going anywhere, and certainly in this environment that we've seen where some of the more traditional kind of syndicated lending markets and other things have kind of dried up, it's been a really important way of actually getting buyout transactions financed. So yeah, I don't know. There's other things probably you guys want to add, but maybe pause there and let someone else come in.
Colin?
Yeah, so I think I'm also in the 2%.
Yeah.
I think what the survey highlights is, I think perhaps the need for broader education as to what private credit is. I read quite a few of the media pieces, and it was conflating government bond trading, hedge funds, all in this same bucket. So when I look at what I consider to be private credit, I think you have an asset class that's very well aligned to prevent capital losses. I think an asset class which has got a very structured due diligence process and is actually a very good steward of capital. So I think that the 98-2 indicates that there's probably a broader education required about what private credit investing entails.
Yeah. Deborah?
Yeah, I'd echo that. If you look at numbers of kind of default rates, recovery rates, it paints a very positive picture for private debt versus other asset classes. And I guess I'm kind of for our lens, what's really important on our side when we're thinking about allocating to private debt, we see it as an attractive opportunity today, and it's again down to that manager selection. So it's about making sure that we're conducting kind of thorough investment due diligence on the GPs, on the strategies, to make sure they have the right tools and skill set to be underwriting, to be stressing the businesses, to be asking, okay, how's this going to perform in certain market environments, but also making sure they're writing and structuring the loans in a way that they're building in protections, in covenants, to provide and mitigate that downside protection as much as they can. But let's be realistic, right? We are going to see companies struggle. that it's not, everything's not going to be rosy forever. And then again, I think, well, what's the opportunity there? And for clients looking to deploy capital today, there's the option of maybe looking more at GPs with more of a stressed or distressed capability. Mm-hmm. So if we're thinking about how some companies do struggle and loans are maybe going to be sold on the secondary market, that could be an opportunity for some of these players to actually get some loans at significant discounts to par. So creating another opportunity set there as well. And then maybe the last thing I'd say on private debt or private credit is when we think about it in a portfolio and building out an allocation to private debt, the asset class itself has evolved hugely. It's not just direct lending anymore. We talked about NAV lending earlier. And that's an area, again, from a diversification standpoint, from a client building out exposure to private debt, that could be an element they can add to their portfolio, which again is providing that diversification. So I think there's it has evolved. There's a lot more under the bonnet than it used to be. So again, I would say also in the 2%.
Go on, Zach.
It's an echo chamber. Yeah. I mean, look, I hate the term because it's sort of amorphous, right? In the same way that, I don't think private equity moves in sync across every sort of facet of private equity, and it's the same is true about private credit, because you have to look at the underlying asset that you're lending against, and private credit is a massive umbrella term. Mm-hmm. I agree, it's a heavily commercial, professional, highly diligenced asset class. I think there's a bit of a stigma around credit in general, but it's not like a mortgage-backed security, right? Or other types of kind of debt instruments that are overly indexed to exogenous macro factors, right? There are businesses fundamentally underlying those credits or assets or infrastructure. So to just lump it all together, I don't like. I do think that parts of the private credit market will suffer more than others, right? But if you think about it, if you're loaning to a healthcare services business or a tech company or a commercial real estate manager, those are going to have much different risk profiles, and so then it comes back to the manager. So I'm certainly not in the 98%, but I think there will be pockets of private credit where that statement is true.
100% of you in the 2%. I'll just ask one more question then before opening up to the audience. And it's a question on skill set. So a lot of what we've talked about, whether it's growth of private credit or difficulty fundraising, points to the lack of M&A, which has obviously been created by a number of macro factors. But having said that, as private equity has grown over the last 10, 15 years, it's become very heavily intermediated. Some could argue that deals have become quite formulaic or sort of cookie cutter in the approach of putting them together. So I wonder whether you think that the private equity investors of today have the skills required to do deals in more challenging environments where transactions, if they are going to come together, will be much less neat around the edges. I'll start with you, Deborah.
I think it's a fantastic question, and I think it's something we often ask ourselves, and it's a challenge to distinguish between what's been strong performance because of the market environment and what's been strong performance because of, as you say, that underlying skill, driving returns and driving value creation. And it's, again, going back to the point about, I think investors are becoming much more intelligent and really understanding what we're investing in, so they're demanding that transparency from the managers to really understand how they're driving that value creation. And I think that will continue to be a challenge. I think we were talking about this briefly earlier, and I think some of the vaguer points, I'm not going to fully steal it, but I will just highlight it, is the point that the importance of having, I guess, kind of multi-generational teams. And it's because, again, the market environment we've been in, again, as I said before, in the last 10 years has been an interesting market environment, but where it's been more the exception rather than the rule of getting something wrong. And I think as we look forward, it's going to become more challenging. So having a broad team, a diverse team that you can lean on to share their experiences of different market environments, different cycles, is going to be really important. Back to my earlier point as well, it is about demonstrating that ability to generate value in different market cycles And as we say, what have been tailwinds are now headwinds. And it's then going to be about making sure that you've got that operational expertise, you've got that ability to expand geographically, if that's going to be the driver of return. So essentially you can build the earnings of a company before you sell it in a different way.
Sorry, go on, Con.
I was going to say, I mean, just echoing what Deborah said, I think it comes back to what we would see as the importance of backing managers that have that institutional memory, that experience of lots of, so no market cycle, no market conditions, they never fully repeat themselves. So it's a broad skill set of how you cope with change. So I think, in this current environment, and even if, so I'm not sure I necessarily accept the premise of the question, but even if you do assume that everything's very heavily intermediated, to Deborah's point, what matters is what value you can then add. Yeah. If you work on the premise that it's a really efficient market and the price is what it is, it's what you can do with the company once you've bought it. And one of the things I've seen over the last 15 years, and I've started my career in private equity, talk about market timing in 2007, but one of the great evolutions has been the increasing sophistication of what managers do whilst they own a company. So used to be the perception that it was just levered equity. But now when I look at our stable of managers and they're employing people who are experts in pricing, data science, it's a whole sort of range of different skill sets. And they are bringing to bear that experience to their companies, who are often, smaller mid-market companies who don't have access to these large corporate platforms. So that's a real source, we think, of value generation. And it's one of the areas where there's been a really positive evolution in the market.
Yeah. Alex?
I agree with all of that, and maybe just to take it in a slightly different direction, when you kind of go back to the question around cookie cutter transactions and intermediation. I think intermediation has always been part of the landscape, and if you have a founder, any other owner of an asset, they are often going to take professional advice around that transaction. I think that's a natural and logical thing to do. But when we look at the managers in our portfolio, even if a process ends up being to an extent intermediated, that understates the level of pre-work around origination, whether it's kind of sector mapping, meeting companies, speaking to founders, really understanding what is it that they would want out of a partner and out of a transaction. And then even at the end of that process, which can be months, it can be years, results in an intermediated transaction. There's a huge amount of hinterland to that deal, which requires all sorts of deal craft and sector understanding and kind of entrepreneurial empathy. So I think I would disagree and challenge the kind of premise of the question for that reason. And then the other thing I would say is, since the market's turned, what we've seen in our portfolio is lots of public to private transactions, which are hugely complex, partnership and kind of minority transactions with entrepreneurs, very messy and difficult carve-outs of divisions and kind of divestitures from bigger corporates. So I think the old art, as it were, of kind of deal craft is very much kind of alive and well. Yeah.
Zach, what do you think?
I think it's very firm specific. I would agree with the premise that there has been, from my perspective, sort of increased laziness in the private equity sector. If you look at the tech markets, again, there were so many deals being done. There's a high degree of intermediation that firms did get accustomed to doing deals a certain way, and also the velocity of deal doing was very fast, which means firms had to be comfortable sort of being nimble, moving quickly, making investments based on, especially here in the UK and Europe, vendor side DD, et cetera. And so there was a much higher degree of cookie cutter processes, for buyers. And I do think there were firms that sort of fell victim to that mentality of just, this is the way deals are getting done now, and so let's kind of reshape our organization to accommodate these types of transactions. And then the transactions stopped happening, right? So, and now firms need to be creative. So there are a lot of smart people in private equity, so people will figure it out. But it will be interesting to see how this plays forward, because there are generations of managers in the last 5 to 10 years that, maybe didn't grow up in an environment where they were creating deals per se, but deals were really coming to them. And I think, I don't know that we're going back to that environment, but there's probably some type of middle ground that we're going to settle in.
Great. I'll open up to the audience for any questions now, if we have any. One here. Al, thank you to you, by the way, for your stellar work on the questions today.
I've been promised a very lavish lunch by one of your colleagues.
Yeah, there must have been a reason. Yeah.
That's right, isn't it?
That's correct, yes.
So I've got two questions, but they're really practitioner questions. If you were looking at a deal that you can fund entirely yourself, would you fund it entirely one-to-one, equity and credit within your own firm? And what would the Chinese walls or restrictions, would there be any?
I'm trying to think who would be best placed to answer that question. Any of you?
I mean, I'm happy to start. So, I mean, in terms of our business model, if you think about the equity side of our business model, where we're doing a direct transaction, we're always a co-investor in those transactions. So we don't have a lead direct equity business. We don't want to compete with the general partners with whom we invest. So we're never, call it, driving the bus on the equity side of the balance sheet. And then on the credit side, again, we're not tending to lead those transactions. We're more of a kind of syndicate participant in those deals. So the short answer is we have very clear rules and guidelines if we are on both sides of the balance sheet, because fundamentally what we're solving for is we never want to be in a position where there's a direct conflict, but in a restructuring case, a direct conflict between being an equity holder and being a debt holder, and so we solve for that kind of through multiple different guidelines. But we would never be kind of leading the bus, most likely on either side of the balance sheet, but certainly not on both simultaneously.
Yeah, I think we could say the same as well. We would never be the lead debt investor and the lead equity provider in any deal. Mm-hmm. That would be. But in terms of how the teams are run, and I think this would be true of most diversified managers, there are separate pools of capital, separate reporting lines, segregations within maybe one firm, but different investment committees, and a very segregated way of running the different pools of capital.
Thank you.
Any other questions? Yeah.
Hi, Harry Seekings. I'm curious whether the panel think there is a credibility issue around the valuation of private equity assets. If any of you do, how that might play out over the coming months and years.
Mm-hmm. Does anyone want to take that first?
I think there is a credibility issue. I'm personal view, and I'm perhaps talking my own book. I'm not sure it's necessarily well placed, but there is definitely, in terms of feedback we get from investors, there's a lot of challenge around, I'm seeing this happen with my public portfolio, but not necessarily with my private portfolio. And some of that, is to do with, I think, sometimes buyout portfolios have a very different composition to a typical public portfolio. So a lot of it is to do with the sector adjustment, and also the different types of companies we're investing in relative to what is available on public markets, or what the larger components of the global indices are. You look in the UK, and the FTSE is very heavily indexed to financial services, oil, natural resources. Almost, very limited exposure in a typical buyout portfolio to those sectors. So, I think some of it is And I think, what we see is that actually managers have built up much more robust processes around valuations in response to investor demand. And they've also, but when we track the data, we have a very consistent pattern of things being realised in an orderly fashion. So we don't have lots of ancient investments kicking around in the cupboard. And we also see that when things are realised, that if anything, it's a relatively conservative approach. So typically we see quite significant uplifts to the previous carrying value when we get a realisation. So, I think it also probably comes under the category of, as a nascent industry that's tripled in size since the last significant cycle, in some ways there isn't a huge amount of data. So I do think, in summary to your question, I do think there is a credibility issue, but I think it's one which the passage of time and education will hopefully help to get over.
I think I add to that is my comment earlier about the transparency piece, and I think if you ask GPs, they're very willing to talk you through their process, and I think it's just kind of getting that connection between people who are investing, understanding that, so the education piece, I think that will help with the transparency piece.
The only other thing I'd add is we do track the data in terms of realisations. It's kind of similar to your point, realisations that happen out of the portfolio, and over the long kind of arc of history, that tends to be at about a 30-ish% premium to the prior book value a quarter or two before the exit. So that's what actually happens at the back end of the holding period. I think what's probably underappreciated in the market, and certainly the public market investors in private equity, is that in the peak years, so in 2020, 2021, the premium to book value at exit exploded. So the assets were being sold not at the historical 30 or 40% premium, but in some cases 100% or more, which reflects the fact that the managers were not taking the full extent of the melt-up in public equity markets into their valuations on the books. And consequently, when public markets corrected, the need for the adjustment on the private side was just a little bit less severe. And I think that's probably a sort of underappreciated fact.
Yeah, we weren't getting calls in 2021 saying, why aren't you marking up your portfolios more? But we were getting calls, a few months ago saying, why aren't they coming down? And just another point to add to that, I think it's also important to note that unlike other asset classes, in private equity, managers are not remunerated based on unrealised marks.
Yes.
So it's very much, things like carried interest, come off cash returns.
Yes.
So there is no incentivization, on the part of managers to inflate valuations.
Yeah, the only other thing I would add, if you look at the venture capital side of the industry, you have to remember that a lot of LPs are sharing GPs who are sharing deals, right? And so you can look as an LP, you can look across your portfolio and look at the underlying portfolio company, so your portfolio of managers, look at the underlying assets and kind of judge them against each other. So how is this GP valuing the same business that's co-invested with another GP? Because most venture deals will have multiple sort of institutional backers. And so the larger and more sophisticated LPs kind of have visibility across that, and GPs know that, right? So I do think there's a pretty strong incentive to take your medicine when you need to, which the past couple of years has been that environment, because you know that your LPs have visibility outside of just the lens of your own portfolio.
That's a good point. I think that's all we've got time for. So it's the end of the session and the end of the summit. So thank you all for coming. Thank you, LSEG, for hosting us. Please do join us for drinks and lunch outside.